In a world dominated by noise, hype, and algorithmic precision, the Tao of Trading cuts through the clutter with uncommon clarity. Simon Rhee has crafted a masterwork that merges ancient Eastern wisdom with the brutal, modern reality of financial markets. This is not a book about chart patterns or indicators. It's a book about you. Rhee's approach is revolutionary in its simplicity. He doesn't preach edge hunting or high frequency exploits. Instead, he invites traders to look inward, to recognize that success in trading is not determined by external tools, but by internal alignment. Trading, he reminds us, is not a battle against the market, but a journey through our own psychology, fear, greed, and uncertainty. Unlike technical manuals that grow obsolete with each market cycle, the Tao of Trading is timeless. Rhee draws on the principles of Taoism, not as metaphor, but as practical trading philosophy. His message is clear. If you cannot master your own mind, you have no chance mastering the market. The market doesn't reward intelligence. It rewards self-awareness, discipline, and detachment. This book speaks directly to the seasoned trader who has seen multiple market regimes, as well as the new entrant lost in a maze of strategies. It reminds us that consistency flows not from perfection, but from surrender. That risk management is not a rule, but a way of life. And that the true edge lies not in prediction, but in presence. What sets Rhee apart is his authenticity. He's walked the trading floor, seen fortunes made and lost, and emerged with humility. His writing is sharp but never arrogant, calm yet penetrating. He doesn't sell hope, he teaches resilience. The Tao of Trading is not just a guide, it's a mirror into the trader's soul. If you're seeking a book that tells you what to buy and when to sell, look elsewhere. If you're seeking a book that will change how you think, feel, and behave in the face of risk, this is it. Required reading for every trader who seeks more than just profits, but mastery. Core philosophy: trading as an inner journey. In the complex world of financial markets, where billions move in milliseconds and sentiment shifts faster than logic, many traders enter with the belief that success lies in information tools and tactics. They chase perfect setups, high win rates, and foolproof strategies, as if the market can be conquered through external knowledge alone. Yet the longer one survives in this environment, the clearer one truth becomes. Trading is not a contest between you and the market. It is a conversation between you and yourself. Trading is an inner journey disguised as a financial activity. The market does not care about your education, your ambition, or your technical setup. It only reveals how well you understand yourself. If fear dominates your mind, it will show in premature exits and missed entries. If greed drives your behavior, it will manifest in oversized positions and emotional trades. If you lack patience, the market will expose it by luring you into every noise-filled fluctuation. The market is not your enemy. It is your mirror. It reflects back your psychology with precision and without mercy. Most traders fail not because of a lack of strategy, but because of an absence of emotional discipline. A profitable system becomes useless when run by an undisciplined mind. A sound plan cannot protect you if you abandon it during drawdowns. Psychology is not a side note in trading. It is the foundation. Until you gain control of your internal responses, no amount of technical skill will save you from repeated self-sabotage. At the core of this inner journey is the concept of emotional awareness. Your emotions are not problems to be eliminated. They are data to be observed. The urge to act out of fear or revenge or desperation does not disappear by force. It softens only when acknowledged without judgment. The skilled trader does not react to emotion. They respond to it with clarity. They recognize tension in the body before it becomes impulsive action. They understand the mind's need for control and meet it with process, not prediction. Another dimension of this journey is ego. The ego desires to be right. It wants to win every trade to prove itself worthy. But the market is not a place for validation. It is a place for risk management and neutrality. When your identity becomes attached to your profit and loss, your emotions fluctuate with every tick. A winning trade inflates your confidence. A losing trade damages your self-esteem. In this state, your decisions are no longer objective. They are personal and emotional. Ego and trading do not coexist peacefully. One must yield to the other. Letting go of ego does not mean giving up ambition. It means releasing the need to be right. It means accepting that losses are not failures, but part of the game. It means understanding that no single trade defines you. The professional does not measure success by outcome. They measure it by consistency of process. Their focus is not on being correct, but on being disciplined. They follow their plan with precision, knowing that edge plays out over time, not in a single position. Presence is another pillar of this inner work. In a digital age filled with alerts, distractions, and pressure to act, presence is a rare but invaluable state. Presence allows the trader to remain fully engaged without being emotionally entangled. It sharpens observation and improves timing. It eliminates the noise of should have and what if and brings focus to what is. A present trader sees what is happening, not what they hope or fear is happening. This clarity reduces error and supports execution. To cultivate presence, a trader must train attention like a muscle. This may involve routines like journaling, breath awareness, or simply reducing unnecessary inputs. Trading while distracted is gambling. Trading with awareness is professional. The difference lies not in tools, but in state of mind. Awareness breeds patience. Patience allows selectivity. Selectivity leads to higher quality trades. This sequence begins not with knowledge, but with attention. Another aspect of the inner journey is the concept of surrender. This word may seem passive, but in trading it represents strength. To surrender means to accept uncertainty, to release the illusion of control. The market is larger than any trader. It cannot be forced into alignment with your expectations. You do not control outcomes. You control preparation. You control execution. You control response. Surrendering to the nature of the market means flowing with it, not resisting it. Like water adapting to shape, the trader who surrenders adapts without losing core principles. This surrender allows flexibility. A rigid trader misses what the market is saying. A flexible trader adjusts without hesitation. They are not emotionally tied to a narrative. They do not fight price. They follow structure. This does not mean abandoning conviction. It means holding conviction lightly and adapting when context changes. This is how discipline and adaptability merge into competence. Resilience also emerges from this internal work. True resilience is not about never feeling frustrated or anxious. It is about recovering quickly. It is about returning to a centered state after disruption. The resilient trader does not avoid difficulty. They embrace it and remain operational. They have routines that ground them. They know how to reset after setbacks. Their identity is not built on short-term results, but on long-term consistency. Resilience is rooted in preparation and acceptance. You prepare your system, your risk, your schedule. Then you accept the outcome without judgment. If the trade works, you move on. If it fails, you learn and move on. You are never broken by a loss nor overconfident after a win. You remain steady. This psychological steadiness is what allows compounding to happen. It is what keeps traders in the game long enough for edge to express itself. As the inner journey unfolds, a shift occurs. The trader begins to understand that trading is not a means to chase excitement or approval. It becomes a discipline of clarity, a practice of alignment, a way to develop presence, purpose, and patience. The charts are no longer a battleground. They are a canvas. The trader becomes less reactive and more intentional. They trade not to escape emotion, but to understand it. Not to prove anything, but to refine everything. Mastery in trading is not found in more information, but in deeper awareness. It is not about conquering the market, but about regulating the self. The great paradox is that when the trader stops trying to force outcomes and starts trusting process, results often improve. Not because of luck or magic, but because the trader stops interfering with their own edge. In the end, trading as an inner journey is not a philosophical luxury. It is a practical necessity. The market tests more than your analysis. It tests your patience, your honesty, your discipline. The only way to pass these tests is to develop from the inside out. This journey is not linear, and it is never truly complete. But it is the only path that leads to lasting competence, peace, and performance. Trading as an art, not a formula. In an industry obsessed with precision, many traders fall into the trap of treating the market like a problem to be solved rather than a rhythm to be understood. They collect rules, build models, and run simulations in search of the perfect setup that will work in every condition. They believe there is a secret formula, a code that if cracked will unlock endless profitability. But the truth is more nuanced. Markets are not equations. They are environments. They are complex adaptive systems fueled by human behavior, perception, and reaction. And human nature does not obey formulas. It responds to context. To treat trading as an art is not to ignore structure or abandon discipline. It is to recognize that the same setup can play out differently depending on volatility, sentiment, or timing. It is to understand that price is not just a number, but a narrative. It tells a story of fear, optimism, imbalance, and resolution. Interpreting that story requires more than rules. It requires sensitivity. The trader becomes an interpreter, not a calculator. Art requires presence. A painter does not ask if every brushstroke will succeed. They immerse themselves in the canvas. They trust their hand, their eye, and their rhythm. Similarly, the trader must learn to engage with the market in real time. This does not mean improvising recklessly. It means balancing structure with flow. It means knowing when to act and when to wait, when to hold and when to exit. The best trades are not always textbook. They are contextual, intuitive, and timely. This intuition is not magic. It is the result of hours of observation, of studying price behavior across market cycles, of learning to feel momentum without prediction. It is built from experience but refined through awareness. Many confuse intuition with guessing. True intuition in trading is recognition without conscious calculation. It is seeing a familiar pattern emerge not just in shape, but in energy, in behavior, in the interaction between price and context. Formulas can be taught. Art must be developed. This is why two traders can use the same system and get wildly different results. One treats the system as gospel, the other adapts it with intelligence and nuance. One clings to rules in all conditions. The other understands the spirit behind the rules and adjusts as needed. The difference is not knowledge. It is flexibility. It is the ability to read the market as a living, dynamic environment, not a static machine. This approach demands deep focus. When you treat trading as art, you begin to notice subtle details. The way price reacts to a level, not just that it reacts. The strength of rejection, the follow-through, the volume behavior. You become more attuned to shifts in sentiment, more responsive to structural changes. You stop looking for signals in isolation and start seeing them in relationship. This is the eye of the artist. Pattern and proportion matter. Timing and energy matter. Context becomes everything. An artist also understands restraint. Not every space on the canvas needs paint. Similarly, not every market move requires action. Sometimes the greatest skill is patience. Waiting for alignment, for clarity, for the right combination of factors to emerge. This restraint is not passive, it is active awareness. The artist watches the canvas evolve before choosing to engage. The trader watches the market breathe before stepping in. This kind of patience is rare in a culture that rewards speed and noise. But in trading, it is often the difference between success and chaos. Moreover, art includes imperfection. No masterpiece is flawless. No trade is guaranteed. Embracing the artistic nature of trading allows room for error without collapse. It creates psychological flexibility. You can take a loss without spiraling. You can miss a move without chasing. You begin to see each trade not as a verdict on your skill, but as one brushstroke in a larger painting. Over time, the picture becomes clear. The goal is not to win every trade, but to stay in flow, to stay aligned, to express your edge consistently. This artistic mindset also fosters creativity. You are not limited by rigid systems. You can explore multiple approaches across timeframes, instruments, or market conditions. You can develop new ways of managing risk, of scaling in and out of trades, of framing your setups. Creativity in trading is not recklessness. It is innovation grounded in process. It is the courage to evolve when the market shifts. It is the willingness to test, adapt, and refine without emotional attachment. Discipline does not disappear in this framework. In fact, it becomes more vital. But discipline shifts from obeying rules blindly to honoring principles deeply. Your process becomes a set of guiding boundaries, not prison walls. It keeps you grounded, but gives you room to move. This is the sweet spot where structure and freedom meet, where logic and intuition complement each other, where edge is not just calculated but felt. The market is dynamic, so must be the trader. Rigid formulas often collapse under pressure because they lack adaptability. Artistic trading endures because it is based on awareness, pattern recognition, and timing. It bends but does not break. It flows with the market without losing form. This is why trading remains one of the most mentally demanding professions in the world. It challenges not just your analysis, but your creativity, your perception, your emotional agility. It asks you to think critically, yet feel intuitively, to plan precisely, yet adapt rapidly, to execute decisively, yet accept uncertainty. This balance is not found in books, it is cultivated in experience. Ultimately, to trade as an artist is to approach each day with curiosity, not certainty, to respect the market as a force, not a formula, to see your trades not as bets, but as expressions of your understanding. When you stop trying to force the market into your system and start aligning yourself with its rhythm, you begin to trade with grace. Not every trade will be perfect, but your process will become elegant, consistent, and uniquely yours. Trading then becomes not a rigid job, but a craft, a place where precision meets intuition, where skill meets insight, where the trader stops being a technician and starts becoming a strategist. And just like great art, trading well is not about following instructions. It is about understanding deeply, practicing relentlessly, and expressing with clarity. Emotion, the greatest enemy in trading. Among all the factors that determine a trader's success, none is more powerful or more dangerous than emotion. Markets are built on uncertainty and volatility. They move in ways that often defy logic and violate expectations. In this environment, emotional stability is not just helpful, it is critical. Yet for many traders, emotion remains the most overlooked and underestimated force. It quietly distorts perception, hijacks decision-making, and leads even the most skilled individuals into poor trades and irrational behavior. Fear and greed are often cited as the two dominant emotions in trading. While accurate, this simplification only scratches the surface. Emotions in trading are layered, nuanced, and deeply personal. They are tied not only to money, but to identity, belief, and experience. A losing trade can feel like rejection. A missed entry can trigger regret. A drawdown can ignite panic. These reactions are not simply mental, they are physical. The body responds with tension, heart rate changes, and adrenaline surges. When unmanaged, these signals override logic and discipline. Fear often manifests in hesitation. A trader sees a valid setup but cannot pull the trigger. They recall previous losses or imagine worst-case outcomes. Their mind floods with doubt and their hand freezes. Alternatively, fear can push traders to exit too early, cutting profits short because they are afraid of giving it back. They do not trust the setup or their strategy. They only trust the feeling of safety, which often results in underperformance. Greed operates differently. It creates overconfidence and impulsivity. After a few winning trades, the trader begins to believe they are invincible. Risk parameters are ignored, position sizes increase, and caution fades. Greed tempts traders to chase moves, stretch targets, and re-enter after exits. It convinces them that more is always possible and that market trends will continue indefinitely. Eventually, this leads to oversized losses and shattered confidence. But the emotional spectrum in trading is wider than just fear and greed. There is frustration after repeated stopouts. There is revenge after taking a hit and wanting to make it back quickly. There is boredom during slow market conditions that leads to forced trades. There is euphoria after a big win, which often leads to reckless behavior. Each of these emotional states clouds judgment in its own unique way. None of them lead to consistency. The challenge is not to eliminate emotion, but to become aware of it. Emotion is not the enemy itself. Unconscious emotion is. A trader who is unaware of their emotional state will be ruled by it. They will act on impulse, believing they are being logical. They will change plans mid-trade, add to losing positions, or skip entries because of invisible fears. The solution is to build emotional literacy, the ability to recognize, label, and observe feelings without being consumed by them. This requires training. Most traders spend endless hours studying charts, but very little time studying themselves. Yet the inner chart is the most important one. It tells you what drives your decisions, what triggers your fear, what feeds your need for control. Keeping a trading journal, not only of entries and exits, but of thoughts and emotions, can reveal patterns far more important than price behavior. When you see that your worst losses come after emotional highs, or that hesitation follows losing streaks, you begin to identify the real variables affecting your results. Emotional regulation begins with awareness, but continues with strategy. Breathing techniques can calm the nervous system before entry. Step-away protocols can prevent revenge trades. Daily routines can create stability and focus. Pre-market meditation or visualization can anchor the mind. Trading with predefined rules and automation can reduce decision fatigue. None of these eliminate emotion entirely, but they reduce its power. They give the rational mind a chance to lead. Managing emotion also means managing expectations. Many traders approach the market with unrealistic goals. They expect daily wins, constant growth, and no drawdowns. These expectations set them up for emotional volatility. The market does not operate on your schedule or your plan. It rewards patience and punishes entitlement. When you accept that losses are part of the game, that some trades will fail, and that edges play out over time, your emotional responses begin to shift. You stop taking losses personally. You start viewing them professionally. Emotional resilience also depends on your relationship with risk. Traders who risk too much cannot think clearly. They are emotionally attached to outcomes because the stakes are too high. Proper position sizing is not just a risk management tool, it is an emotional management tool. When you can afford to lose, you trade from a position of strength. When you cannot, you trade from a place of fear and survival. The emotional state behind the trade often matters more than the technical setup itself. There is also the danger of emotional addiction. Some traders do not want consistency. They want excitement. The rush of a big win, the thrill of high leverage, the intensity of fast markets becomes a drug. These traders are not operating a business. They are feeding an emotional need. Until this is recognized, performance will remain volatile and unsustainable. True trading mastery comes when the trader no longer seeks emotional highs. They seek clarity, simplicity, and repeatability. Detachment is the final stage of emotional maturity in trading. It is the ability to remain neutral, win or lose, to feel emotions without being directed by them, to stay aligned with process even when outcomes are unfavorable. Detachment is not apathy. It is grounded engagement. The detached trader does not react, they respond. They do not chase, they wait. They do not overcorrect, they adjust. This mental state cannot be forced. It is cultivated through repetition, discipline, and internal reflection. Ultimately, the market is an emotional amplifier. It will expose every weakness, every wound, every unresolved fear. It will force you to see yourself clearly. For some, this is painful. For others, it is liberating. Those who grow emotionally will grow financially. Those who avoid this work will repeat their mistakes regardless of strategy or system. Emotion is not the enemy to be feared. It is the fire to be mastered. When properly understood, it becomes a signal, not a threat, a source of awareness, not anxiety. The greatest enemy is not the market or other traders. It is the untamed emotion within. And the greatest ally is the trader who learns to observe, breathe, and act with calm precision, even as the world moves in chaos. Discipline. The core of sustainable profitability. In trading, nothing is more predictive of long-term success than discipline. Strategies vary, tools evolve, and markets change. Yet the one trait shared by consistently profitable traders across all styles and asset classes is unshakable discipline. It is the invisible backbone behind every well-executed trade, the unseen driver behind every professional routine. Without discipline, no edge is reliable and no system can survive real market conditions. Discipline in trading is not about rigidity or force. It is about alignment. It is the capacity to act in accordance with a predefined process, regardless of emotion, noise, or temptation. It is choosing structure over spontaneity and process over impulse. When you are disciplined, you do not react to markets, you respond through rules. You do not chase trades, you wait for confirmation. You do not deviate after wins or panic after losses. You operate like a surgeon with calm precision. Many traders misunderstand discipline as willpower. They believe it is about pushing harder, resisting temptations, or being mentally strong enough to endure discomfort. While willpower plays a role, it is a limited resource. It fades under fatigue and stress. Real trading discipline is not based on brute force, but on design. It is built through habits, structure, and clear decision frameworks that reduce emotional influence. One of the most important components of discipline is consistency. A trader must follow the same process trade after trade. Entry signals must be taken every time without hesitation. Stop losses must be respected regardless of the trade's potential. Risk must be fixed and position sizes controlled. Many traders break discipline not out of recklessness, but out of inconsistency. They follow rules when it feels good and abandon them when it does not. That is not discipline. That is convenience. True discipline is revealed in difficult moments. When you are in drawdown, can you still trust your system? When the market is irrational, can you still stay on the sidelines? When other traders post massive wins on social media, can you still follow your plan without FOMO? These are the moments that separate professionals from amateurs. Anyone can follow a plan when things are working. Discipline is what you do when they are not. Routine is a critical part of building discipline. You must turn trading into a structured practice, not an emotional roller coaster. That means trading at specific hours, reviewing charts at the same time, journaling consistently, and having a set checklist for every trade. The goal is to eliminate randomness. Every decision must have a reason, and every action must be documented. The more structured your process, the less room emotion has to intervene. Environment also affects discipline. Trading from a clean, quiet space without distractions helps you stay focused. Having reminders of your rules near your screen reinforces structure. Taking scheduled breaks and stepping away during volatility protects your mental capital. Discipline is not only internal, it is shaped by the environment you create for yourself. If your workspace is chaotic, your mind will mirror that chaos. Accountability strengthens discipline. Many traders operate in isolation with no one to report to. This leads to lax behavior and rationalizations. But when you commit to a trading plan publicly or with a mentor, you introduce a layer of responsibility. You begin to take your own rules more seriously. Journaling and post-trade analysis also build self-accountability. When you know every decision will be reviewed, you trade with greater care. Discipline must also be flexible. Markets are dynamic, and no plan works forever without adaptation. The disciplined trader is not stubborn. They are committed to their framework, but open to evidence. They know when to pause, reassess, and refine. They do not change rules mid-trade, but they are willing to evolve their edge over time. Discipline is not about being unchanging. It is about being anchored in process while adaptive in application. There is a deep emotional benefit to discipline. When you follow a structured plan, you reduce regret. You accept outcomes more easily because you know you did your job. Win or lose, the process was followed. This reduces emotional volatility and builds confidence. Over time, you become less attached to single trade outcomes and more focused on long-term execution. This shift in mindset is what allows profits to compound over time. Discipline also builds trust, not just in your system, but in yourself. Every time you follow your rules, you reinforce your own reliability. Every time you break them, you damage that trust. Many traders struggle not because their strategy is wrong, but because they no longer trust themselves to execute it properly. Rebuilding that trust requires a return to basics, small wins, and repeated follow-through. Risk management is the purest expression of discipline. You cannot control the market, but you can always control your risk. Setting stops, sticking to them, and sizing trades properly are all acts of discipline. They are not exciting, but they are essential. When traders override stops or double down on losers, they are not just breaking rules, they are destroying the foundation of sustainable performance. Patience is another form of discipline. Waiting for the right setup, not forcing trades during sideways markets, and resisting the urge to overtrade are all signs of maturity. Most bad trades come from impatience, not ignorance. The market offers opportunities daily, but not all of them are yours to take. Discipline teaches you to filter noise and act only when your criteria are met. This is how capital is preserved and grown. A disciplined trader views trading as a business, not a game. They operate with plans, track metrics, analyze performance, and seek continuous improvement. They understand that success is not measured by one day or one week, but by years of consistent behavior. They know that edge plays out over time, and that variance is inevitable. Because of this, they are emotionally steady, even through setbacks. In the end, discipline is the bridge between knowledge and results. You can have the best system in the world, but without discipline, it is worthless. You can know everything about psychology, but if you cannot act consistently, it does not help. Discipline is the force that transforms theory into practice and ideas into income. It is not glamorous, but it is powerful. It is not easy, but it is learnable. Every great trader has paid the price of discipline. They have endured boredom, monotony, and frustration. They have faced temptation and chosen rules. They have stayed in the game when others quit. That is why they win. Not because they are smarter, but because they are more consistent. Discipline is the foundation of all professional performance in trading. Without it, everything else falls apart. Risk and uncertainty are the nature of the market. Every trader enters the market in search of profit, but what many fail to grasp early on is that this pursuit is inseparable from risk and uncertainty. These are not obstacles to be removed, nor problems to be solved. They are the very fabric of market behavior. Risk and uncertainty are not just part of trading. They are trading. At its core, the financial market is a dynamic environment built on the collective actions of millions of participants, each with different goals, timeframes, and information. Prices move not in linear patterns, but through waves of hope, fear, greed, and reaction. These movements are not entirely predictable because they reflect human nature, which is by definition inconsistent. This makes uncertainty a constant companion for every trader. Risk is the exposure to a potential loss. It can be quantified, measured, and controlled. For example, a trader might set a stop loss at 2% of their capital on a given trade. That is calculated risk. Uncertainty, on the other hand, refers to the unknown variables that cannot be precisely measured. These include unexpected news events, market reactions to central bank policies, or shifts in global sentiment. Uncertainty is the shadow that surrounds all your analysis. Accepting the presence of both risk and uncertainty is a psychological milestone in trading maturity. Many novice traders approach the market with a subconscious desire to eliminate risk entirely. They search for perfect systems, flawless indicators, or strategies with zero drawdowns. This is a fantasy. The market is not a machine with guaranteed outputs. It is a living ecosystem. Every trade carries a probability, not a promise. This is why probability thinking is essential. A successful trader does not look for certainty. They operate on edge. They understand that a trade setup might have a 60% chance of success, which also means there is a 40% chance of failure. This mindset shift is profound. It moves the trader from needing to be right to managing probabilities over a series of trades. It also reduces emotional volatility, since no single trade defines their performance. The illusion of control is one of the most dangerous traps in trading. When a trader believes they can predict market direction with high accuracy, they begin to take larger risks, justify poor decisions, and ignore warnings. The truth is, control in trading comes not from prediction, but from preparation. It comes from defining your risk before entering a trade, planning your exit, and being willing to accept loss with composure. Every professional trader structures their entire process around risk management because they understand that capital preservation is priority number one. Profit is a byproduct of controlled risk repeated over time. Without risk controls, even a few bad trades can erase months of work. But with risk discipline, even a modest win rate can produce profitability. Uncertainty also demands adaptability. A trading strategy that worked well in trending markets may struggle during choppy sideways periods. Macroeconomic shifts can render certain setups ineffective. The disciplined trader is not attached to outcomes. They are willing to step back, reevaluate, and adjust. They do not fear uncertainty. They prepare for it. One of the hardest truths in trading is that even the best setups will sometimes fail. Even when all your signals align, the trade can go against you. This is not a flaw in your system. It is the price of participating in an uncertain environment. Accepting this fact reduces frustration and helps traders stay emotionally neutral. The goal is not to eliminate losses, but to ensure that losses are always smaller than wins, and that the process is followed without deviation. Trading psychology must evolve to integrate uncertainty as a normal condition, not a threat. Many traders experience anxiety because they expect the market to behave rationally or reward their effort. But the market owes nothing. You can follow your rules perfectly and still take a loss. This is not unfair. It is simply how risk and uncertainty manifest. Managing uncertainty begins with clarity. When you have a well-defined trading plan, you eliminate many internal doubts. You know what to do when the market behaves in expected ways, and you have contingencies when it does not. You stop reacting impulsively and begin responding systematically. Clarity in process builds confidence even in volatile conditions. Another tool for navigating uncertainty is scenario planning. Instead of entering a trade with one outcome in mind, prepare for multiple paths. What happens if price moves sharply in your favor? What if it stalls or reverses? Mapping scenarios ahead of time allows you to stay calm because you are not surprised by price action. This also reduces emotional reactivity, which is the enemy of consistency. Emotional resilience is a trader's shield against uncertainty. When you accept that you cannot know the future, you stop overthinking. You stop trying to force trades. You begin to act from a place of structure, not stress. This mental shift allows you to stay present in the market, moment by moment, instead of trying to control what cannot be controlled. Traders often ask how to reduce risk. The better question is how to structure risk intelligently. This includes defining how much you are willing to lose on each trade, what percentage of your capital you will risk per day or week, and how you will adjust during drawdowns. These rules give you a framework within which you can act confidently, even amid uncertainty. There is also a deep philosophical dimension to this topic. Risk is the price we pay for potential reward. In fact, the size of the reward is often linked to the level of uncertainty. Without uncertainty, there would be no opportunity. Every great trade, every breakthrough moment in trading comes from stepping into the unknown with preparation, not prediction. Courage in the face of uncertainty is not recklessness. It is informed risk-taking. To thrive in the market, you must develop a mindset that sees risk and uncertainty not as problems, but as features. You do not resent them. You embrace them. You prepare for them. You manage your capital, your expectations, and your emotions around them. This is the mental edge that distinguishes sustainable traders from those who burn out. In closing, it is worth remembering that certainty is an illusion in trading. There are no guaranteed wins, no perfect setups, no secret indicators that eliminate loss. What exists is probability, structure, process, and discipline. When these are combined with respect for risk and awareness of uncertainty, trading becomes not only a method for financial gain, but a path for personal development. Every trade you take is a decision under uncertainty. Every exit is a test of your discipline. Every loss is a lesson in risk. Every win is a result of managing both. The sooner you stop fighting uncertainty and start working with it, the more stable your trading becomes. Risk is not the enemy, it is your partner. Uncertainty is not chaos, it is reality. And your success depends not on eliminating them, but mastering your behavior within them. Flow state, the optimal trading mindset. There is a mental state where time slows down, distractions vanish, and every action feels effortless. This is not fantasy. It is the psychological phenomenon known as flow. In trading, flow is not just a performance booster. It is the optimal mindset where intuition, discipline, and technical skill align. Reaching this state consistently transforms the way traders engage with the market and how they experience decision-making under pressure. Flow was first defined by psychologist Mihaly Csikszentmihalyi as a state of complete absorption in an activity where one loses the sense of time, self-consciousness, and external distraction. In this state, the mind is fully immersed in the present moment, performing at its peak without tension or hesitation. For traders, this means clear execution, unemotional analysis, and an intuitive feel for market rhythm. However, flow is not achieved by accident. It emerges when certain psychological and environmental conditions are met. First, there must be a balance between challenge and skill. The task must be difficult enough to require focus, but not so difficult that it causes anxiety. If the market is too easy, the trader gets bored. If it is too complex, they become overwhelmed. Flow lies in that sweet spot where your ability is tested but not exceeded. Second, flow requires clear goals. In trading, this means having a defined plan for each session, a structured approach, and specific criteria for entries, exits, and risk. When your mind knows exactly what it is trying to accomplish, it can operate without confusion. Clarity is a trigger for immersion. Third, immediate feedback is essential. Traders receive constant information from price movement volume and indicators. This real-time feedback allows them to adapt, and refine their behavior as the market unfolds. It is this ongoing interaction that sustains focus and deepens engagement. To cultivate flow, traders must remove distractions. This means eliminating external noise, but more importantly, managing internal chatter. Doubts, regrets, fear of missing out, and greed are the enemies of immersion. These emotions pull the mind into past mistakes or future fantasies, disconnecting it from the present. A flow state requires mental silence, the ability to observe price without projecting desire or fear onto it. Routine supports flow. Consistent pre-market preparation, structured journaling, post-trade reviews, and physical readiness all build the mental framework needed. When the body is rested, the workspace is clean, and the trading plan is clear, the brain finds it easier to enter flow. This is why elite athletes follow rituals. The same applies to professional traders. Interestingly, flow is not about being hyperactive or emotionally charged. It is a calm, alert state. The trader is fully aware yet free from tension. There is no overthinking. There is no second guessing. Actions are precise but feel natural. It is the opposite of forcing a trade. It is allowing the trade to unfold through practiced attention. When traders operate in flow, they often report losing track of time. Hours pass without fatigue. Decisions seem obvious. It feels like you and the market are moving together, not in conflict. This synergy allows for better pattern recognition, more accurate timing, and reduced emotional reactivity. But flow cannot be forced. You cannot simply will yourself into it. It is a byproduct of preparation, trust, and alignment. Traders who obsessively monitor every tick or overanalyze every signal often block themselves from flow. Their mind is fragmented. Flow requires letting go of control and relying on trained instinct. To make flow more accessible, traders must build confidence through repetition. The more you follow your plan without deviation, the more your mind trusts itself. This trust reduces hesitation and builds momentum. Momentum is key. Flow feeds on flow. One good decision leads to another, creating a loop of clarity and control. Managing risk is also central. If you are over-leveraged, worried about losing too much, or trying to make up for past losses, your brain stays in survival mode. There is no space for flow when fear dominates. Proper risk management reduces pressure, allowing your mind to stay centered and responsive. Self-awareness plays a massive role. Each trader has unique conditions that support or hinder their flow. Some trade best in the morning, others in the afternoon. Some thrive on quiet, others need a bit of ambient noise. Some prefer short-term setups, others perform better with longer time frames. Knowing yourself helps you build an environment where flow becomes natural. The absence of flow often reveals itself in certain symptoms. You hesitate to enter a trade despite all signals aligning. You jump in prematurely without confirmation. You feel rushed, scattered, or fatigued. You overtrade or revenge trade. These are signs that you are mentally fragmented, disconnected from your process, and reacting instead of responding. Flow is the antidote to these problems. It cannot eliminate losing trades, but it transforms how you experience them. Losses do not rattle you. Wins do not inflate you. You remain anchored in process, not outcome. This emotional stability is what allows you to string together quality decisions day after day, regardless of market condition. Developing flow as a consistent part of your trading routine takes time. Start by mastering your preparation. Enter each session with clarity of intention. Use breathing techniques to calm your nervous system before trading begins. Reduce multitasking. Focus only on the market and your plan. Track moments when you feel most focused and try to recreate those conditions. Journaling helps. Write not just what you traded, but how you felt before, during, and after the trade. Over time, you will begin to see patterns. You will discover your personal flow triggers and blockers. This data is more valuable than any technical indicator because it reveals the operating system of your performance. Flow is not perfection. It is presence. It is your full attention married to your best practice. It is when your screen time becomes less about chasing and more about aligning. The best traders in the world do not just have better strategies. They operate more often from flow. That is their edge. Ultimately, flow transforms trading from a battle into a dance. It stops being about forcing the market to pay you and starts becoming about showing up with disciplined skill and presence. You learn to respect uncertainty, navigate risk, and act decisively, not because you predict the future, but because you are fully connected to the now. Financial freedom begins with mental freedom. Before financial freedom becomes a tangible reality, it must first be a psychological possibility. Many traders dream of escaping their 9 to 5 job, achieving consistent profits, and living life on their own terms. Yet few understand that financial liberation is not a switch you flip with a single winning strategy. It begins with a deep internal shift. You cannot be financially free while mentally imprisoned by fear, greed, insecurity, or self-doubt. The mind is both the engine and the brake in trading. It interprets data, executes decisions, and reacts to outcomes. If that mind is clouded by emotional baggage or unresolved beliefs, it will sabotage even the most technically sound trading plan. That is why mastering your mindset is not an optional enhancement. It is the foundation upon which sustainable trading success is built. Mental freedom means detachment from needing to be right. It is the ability to accept uncertainty, to allow the market to do what it does without needing to control or predict it. The mentally free trader does not define their self-worth by a single trade or even a month of performance. They understand that long-term results emerge from consistent decision quality, not emotional reactions to short-term outcomes. A trader who chases financial freedom without first achieving mental clarity often ends up trapped in another form of slavery. They might leave a job they dislike only to become enslaved to their screen, addicted to price action, afraid to step away in fear of missing out. They build walls of anxiety around their capital, treating every fluctuation as a threat. This is not freedom. It is a gilded cage. True freedom begins when your relationship with money transforms. Instead of seeing money as a savior or a source of validation, you begin to treat it as a tool. You stop trading to prove something and start trading as an expression of skill and process. The pressure to win fades, replaced by a commitment to mastery. Mental freedom also involves releasing attachment to outcomes. This does not mean you do not care about profits. It means you no longer let profits or losses control your state of mind. You show up, do the work, manage risk, and let go of the rest. Ironically, it is this detachment that allows profits to accumulate because you are no longer self-sabotaging under pressure. Cultivating mental freedom requires confronting your inner narrative. What stories are you telling yourself about money worth and success? Are you operating from a mindset of scarcity or abundance? Do you believe you need to struggle in order to deserve wealth? Do you associate money with stress or guilt? These unconscious scripts shape every trade you place and every decision you make. One powerful exercise is to journal your thoughts after each trading session. Do not just record the trades. Record how you felt, what you feared, what you hoped for, and how those emotions influenced your actions. Over time, you will see patterns. You will learn that your trading account reflects your internal dialogue. When you change the dialogue, you change the outcome. Another pillar of mental freedom is acceptance. You accept that losses are part of the game, that uncertainty is a constant companion, and that perfection is not required. This acceptance dissolves resistance. When you stop fighting reality, you stop wasting energy. That energy can now be directed toward learning, growing, and improving your edge. You must also let go of comparison. Measuring your success against others, especially in trading, is a shortcut to misery. Every trader has a unique journey shaped by personality, capital, timeline, and psychology. Mental freedom means staying in your lane, focusing on your development, and defining success by your own metrics, not someone else's highlight reel. Clarity of values is crucial. Why are you trading? What does freedom mean to you? Without clear answers, trading becomes directionless. You chase setups and goals that do not align with your deeper motivations. This disconnect breeds frustration and burnout. When your values and actions align, trading becomes more than a job. It becomes a purposeful pursuit. Boundaries also play a role. The mentally free trader knows when to walk away. They do not overtrade to escape boredom or force setups to chase profit. They respect the market and themselves enough to take breaks, recharge, and return with a sharp mind. This restraint is not weakness. It is the discipline of a professional. Financial freedom is often portrayed as a number, a portfolio size, or a lifestyle. But these are external markers. The internal reality is what matters more. Can you sit in silence without needing stimulation? Can you handle loss without spiraling? Can you trust your system without seeking constant reassurance? These are the real indicators of freedom. Traders who cultivate mental freedom begin to experience a shift. They sleep better. They trade less but with more conviction. Their results become more stable, not because the market changes, but because they do. They are no longer trying to control the uncontrollable. They are aligned with the rhythm of uncertainty, operating with poise, patience, and presence. Mental freedom does not mean apathy. It means engagement without obsession. It is the state where you are fully invested in your process, yet emotionally detached from moment-to-moment outcomes. You remain centered whether your trade hits stop loss or take profit because you are not seeking emotional fulfillment from market performance. Your self-worth is intact regardless of the chart. Ultimately, financial freedom becomes inevitable for the mentally free trader. Why? Because they stop repeating the same emotional mistakes. They stop chasing dopamine hits and start executing with clarity. They build habits that compound over time. They stay in the game while others burn out. And most importantly, they enjoy the journey, not just the destination. To summarize, you cannot reach outer freedom without inner freedom. Every dollar you earn in the market is first created in your mind. When you liberate that mind from fear, greed, attachment, and ego, you create the space for real wealth to grow. Freedom is not a finish line. It is a way of being, and it begins within. Conclusion. The journey inward leads the way forward. Trading is often marketed as a path to riches, fast cars, and freedom, but those who endure in the markets know the truth. Trading is not just about charts, entries, and exits. It is a mirror that reflects who you are under pressure. It tests your ability to remain calm while the world screams. It exposes your fears, your greed, and your need for control. More than a profession, it is a path of personal evolution. Throughout this book, we have explored not only the techniques and tools of trading, but the deeper truths that govern sustainable success. We have walked through the mental traps, the emotional battles, and the philosophical foundations that separate noise from signal. We have seen that trading excellence is not found in prediction, but in presence, not in perfection, but in process. True mastery is not measured by how much you make, but by how well you manage yourself when things do not go your way. It is about how you think, how you feel, and how you respond. When you develop the discipline to follow your plan, the strength to accept loss, and the courage to continue when doubt arises, you step into a level of professionalism few ever reach. The goal is not to eliminate fear, but to act wisely in its presence. The aim is not to avoid uncertainty, but to embrace it with preparation and emotional flexibility. The target is not freedom from losses, but freedom from the internal suffering they used to create. This is the trader's real edge. Trading is not something you conquer. It is something you become. Every trade is a step on that journey. Every challenge is a teacher. Every breakthrough is a reflection of the inner work you have done. Success is not a destination, but a natural result of aligning your mindset, your method, and your money. So, as you turn the final page, ask yourself not just what you want to achieve, but who you must become in order to achieve it. The charts will always be there. The market will always move. But your growth, your consistency, and your peace of mind are what truly define your wealth. Remember, you are not just building a trading account. You are building a version of yourself who can handle freedom. If this book sparked something in you, a deeper curiosity, a new sense of awareness, or a drive to master both the markets and your own mind, then I invite you to continue the journey with us. Subscribe to Trading Mindset Lab, your dedicated space for trader psychology, deep dives, real-time mindset coaching, and weekly insights designed to elevate not only your results, but your resilience. Your edge is not just your strategy. Your edge is your mind. Let's train it together. Hit subscribe now. Rewire your mind. Redefine your game.